Hi, my name is Daniele Pinna. I'm head of research and investment at OVIX. We're a lending market on Polygon. During the course of this talk, I will explain how we quantify the risks that users put themselves into and consequently the protocol, and hopefully justify where Oracle expertise could come in helping us quantify these risks better moving on in the future. So the major critiques, I can look down here. The major critiques that we get in DeFi are the usuals. DeFi is becoming too widespread, but what are the underlying contagion risks? What is are these protocols even safe for consumers to use? Can these risks be quantified and taken concretely and worked around in some way or another? And last but not least, are we really making capital more efficient on the blockchain? So this requires constructing a risk assessment framework for what happens on DeFi protocols, and that requires modeling the uncertainty that users are subject to, having a risk assessment engine that can extract quantifiable risk metrics out of the uncertainty, and then implementing risk management procedures, monitoring and reviewing what happens on the protocol, and then it's a feedback loop. It's a continuous work. The work never stops. So in the course of this talk, I'm going to show you how we do this at OVIX. We are just very briefly, we're a lending market on Polygon, like I said, with a V tokenomic sprinkle on top. And we're striving to become the core Polygon money market protocol. All right, so this is like a general picture of the general framework of a lending market. You got lenders, you have borrowers. They interact through our protocol's smart contracts. This protocol is governed by a DAO. It has the various operations are obviously lending and borrowing, well, depositing, lending, and borrowing. And for borrowing and lending, there's a dynamically computed borrow interest rate that borrowers need to pay, and that gets distributed to the lenders with a fee taken obviously by the protocol, and this is all these things are a function of the utilization of capital on the protocol. So if you've been living under a rock and don't know what a lending market is, I apologize if I've dumbed this down too much, but here's just an example of what happens in a lending market with multiple assets. So here we go. Here's an example of Alice. Alice really likes her stable coins. She just wants to generate yields with them. She comes on our protocol and she deposits her stable coins to generate yield. Bob comes around and Bob's has Matic tokens, and he wants to he's gonna deposit those Matic tokens, and he's gonna borrow stable coins collateralized by his Matic tokens, and maybe he's gonna move these off protocol to generate yield in some other weird way, God knows how. And then we got Charlie and Devon coming around, and Charlie's a big Bitcoin maxi, Devon is a big ETH maxi. Charlie is just leveraging up the wazoo, borrowing stable coins collateralized by his Bitcoin, swapping them for Bitcoins and redepositing them on the platform, effectively just creating an ultra leveraged Bitcoin long position versus stable coins. And Devon, on the other hand, is waiting for the flippening. So she's doing kind of like the exact opposite. She's depositing her Ethereum, borrowing Bitcoin, swapping it for Ethereum, redepositing it, and so on and so forth. And then on top of this, all these users have access to liquidity mining through the protocol's token, and they can vote based on the amount of governance tokens that they have on which money market pools they want the liquidity mining to be distributed to. So the point is that all these users are interconnected together, and at any given moment, the protocol has to guarantee that everybody can be made whole. Right? So this means these are multiple assets which with different value propositions assigned to them, different price histories, like statistical price properties, and we have to guarantee that at any moment in time, all the users on this protocol are A, over collateralized, and B, users have the ability to withdraw funds if and when they want to. All right, so how do we assess something like this? Okay, so we built a simulation engine, and the simulation effectively takes in like three main inputs. On the left, you see the price trajectories for the assets on our protocol. On the right, I'll go more into detail on that, and on the next slide, we generate a distribution of user portfolios on the platform, or we can extract them from the users currently using the platform. And in the center are the user actions, right? Like whether they deposit, they're borrowing, borrowing, whether they're swapping, and in the future, many more complex things, right? And then as a result of the price dynamics of the price trajectories of the assets, we can explore how the health level of the users on the protocol evolves over time, and we can see whether they qualify for liquidation at any given moment in time, and we can model the liquidation process with the slippage associated to it, and so on and so forth. And then from this, we can effectively extract liquidation, probability of users getting liquidated effectively, and amounts of liquidation amounts, liquidation counts, and so on and so forth. And we can do this as a function of, for example, simulated asset price volatility. And then by extracting these kind of data out of our simulation, then we can effectively establish performance metrics for our protocol and suggest, for example, optimization of protocol parameters. So this is all, by the way, in a research paper that we recently published in collaboration with Amit Chaudhary, who's head of DeFi research at Polygon. I'll give you a link on the final thank you slide. All right, so the first input, users. So in the first iteration of our simulator, users are pretty passive. A user is defined basically by his total portfolio size and the loan-to-value ratio of his portfolio, of their portfolio allocation, and what the assets in their portfolio allocation are, like whether they're, I don't know, depositing USDC and Bitcoin and borrowing Ethereum and Matic, for example, and in what ratio, right? Typically, the loan-to-value ratio, the LTV, which is on the bottom axis, that's typically the number that is most thrown at users when they interact with lending market protocols. It's a very static measure of user risk on the protocol, but it's what the ecosystem gives them. And so when we can to initialize the simulation, we effectively have to initialize users. And this is one example of a randomly generated ensemble of users on our protocol. You can see like that their average loan-to-value ratio is around 0.6, 0.65, which is consistent with what's seen even bigger money markets in the crypto ecosystem, and similarly, you can see how the log of the user portfolio is distributed, and this is extracted. These are log normal distributions fitted to real-world data that we can observe on chain. The second input, like I mentioned, are the price dynamics. Shown here is just an example of price dynamics that we can generate. So in gray, it's kind of like the envelope of all price trajectories generated in one single simulation, and in color, you see individual price dynamics that we can generate on any given run. To do a mea culpa on this stage, these are extracted from centralized exchange price feeds. But in the future, this needs to happen through oracles, and I'll say something more about this towards the end because I think it's really relevant for the risk assessment stuff. And so we can just track liquidations, right? So for shown here as an example is just like actually this isn't even a generated price dynamic. This is actually Matic's worst price day in its last couple weeks history. This dates back to May, this paper. And you can see like the counts of liquidations as a function of price on our simulated protocol. And all these liquidations, well, like I said, we can model slippage. Every liquidator is assumed to be a rational actor that wants to maximize their profit, and their profit effectively depends on the difference between the incentive and that they get paid by the protocol minus the slippage that they get for swapping out whatever collateral asset of the user that needs to be liquidated. And where we use a relatively standard model for slippage, which depends on the amount being swapped and the total sell side volume available for swapping that asset. It gets a lot more technical in the paper, but yeah. So and then we can do this, and this was an example for one asset I just showed you with Matic, but we can do this for all the assets and all the assets simultaneously on the platform. And this is the kind of stuff that we can extract from the protocol. So shown here is on the left, you can see the total LTV of the protocol, the loan-to-value ratio on the protocol. You can think of it also as a measure of capital efficiency, if you will. In the center, you see the total liquidated funds for like the typical ensemble of users that we were generating in these simulations, and on the right side, the outstanding debt remaining on the platform as a function of different price dynamics for the assets generated with an imposed asset price volatility. Obviously, the higher the volatility, the more liquidations we get, the more the protocol's loan to value gets dropped because liquidators pay back liquidated users' loans. We can construct confidence band intervals around this kind of data, and this is just very quantifiable protocol behavior that you could hopefully expect to see in the real world. My favorite plots, though, from the research we did is to plot what we call the under-collateralization frontier. So there's a very, very big no-no in the DeFi lending market protocols, and that is users should never become under-collateralized. Like I said before, the whole point of a DeFi money market is you have to be able to guarantee that everybody can be made whole with the funds that they deposited on the protocol minus any liquidation risk that they chose to take. So at no point should a user be borrowing more assets than he has on collateral, okay? This, however, isn't a guarantee. Just because you impose users to over-collateralize their position when they deposit funds on the protocol and set up their position, this doesn't mean that a user cannot become under-collateralized. Typically, in moments of extreme market stress, slippage fees can be extremely high for liquidating a user, so a user might not get liquidated for multiple blocks. In this particular paper, we assume just by default that that no user gets liquidated for, there's a 30-block delay, 30-block delay for liquidating any user. It was born out of the fact that we were using 1-minute candles for the price action, but I think it's a pretty nice conservative model for liquidations. And as a function of asset volatility, we can calculate what is the probability that we end up generating more than 1% of under-collateral users. So in other words, of our entire user base, the ensemble users that we simulate, what is the probability that more than 1% of these users become under-collateralized due to market stress? Okay? Obviously, you never want the protocol to be here, but it's to be able to know what it takes to get there, you need to actually see what it takes to get there, right? And that's what we simulate in our simulator. And what we like is we can shown in the straight line is a theoretical like a theoretical curve to model where under collateralization is almost guaranteed to happen. This is whenever the liquidation incentive plus the liquidation LTV of the assets involved becomes greater than 1. So that's just like a general rule of thumb. Never mess around with your liquidation LTV and liquidation incentive above this number, but it's a pretty wide margin. But we can stress it even further. We can simulate our protocol even more times and extract maybe the probability of generating 0.1% under collateralized users. And if you have given enough compute time, you can refine this probability as much as possible. The point of this is that you want to effectively decide, if I list an asset on my protocol, what is the liquidation loan to value ratio and the liquidation incentive that I need to associate to this asset such that my protocol remains healthy. And these are the kind of simulations that we do to assess that. Typically the normal procedure is, market best practices. Like what is the longest standing lending market in crypto? What are they using? Let's start with that. It's clearly safe because they've been around for a while. And that's, there's value to that. But if we want to it's time we raise the bar a little bit more and we try to quantify these things even further. So shown in the yellow rectangle that you see there is kind of like a rough ballpark region of where you'd like liquidation LTV values and liquidation incentives to be for these three assets shown here, which are Bitcoin, ETH, and Matic. The shading on the dots, by the way, is the final protocol LTV as a result of the simulations. It's kind of when I showed you guys the plot earlier, like how the protocol LTV drops over time over the course of a day-long simulation. So obviously, you can depending on where you put your liquidation LTV and your liquidation incentives, you can optimize obviously for capital efficiency. And now this is where I want to do a little tangent and bring it back to oracles. As you may have sensed, if you're following, is that all of this is extremely sensitive to the price dynamics. Right, and more specifically to the extreme tail risk of the price dynamics, because obviously it's if you want to maximize capital efficiency, it's in the protocol's interest to boost things such as the liquidation LTV as high as possible, which means also reducing the liquidation incentive as much as possible because of the theoretical straight line. The problem is that if you boost liquidation LTV and you reduce liquidation incentive, you exacerbate the situation for liquidations. In other words, liquidators are even less incentivized to execute liquidations on unhealthy users on your protocol. And by having a high liquidation LTV, any delay on liquidating a user can lead to their health situation worsening and getting them into an under-collateralized regime before anybody dares to liquidate them, right? So, but if you want to boost these liquidation LTVs as much as possible, it's really important to have a very clear idea of like the tail risk events that effectively your price feed can give you, right? And in this case, these simulations are done, like I said, on centralized exchange price feeds. But if we were to use oracles, I would say that like the thing that would matter the most in this case is if possible, having a clear idea for like what kind of extreme bounds to the threat model that the oracle is subject to, and whether we can extract some sort of like max volatility that we can get that we can simulate price feeds on our protocol with. And so with this in mind, I go back to the original figure that I showed you before. So we have this continuous work of having a risk assessment engine, implementing the risk management on the protocol, and monitoring, reviewing, and adjusting as needed. But this goes way further. Obviously, the obvious case is obviously like within a DAO framework. If you want to add assets on the protocol or modify protocol parameters, it's nice to give your governance participants data-driven metrics for what the upgraded parameters should be, but also from a point of view of improving the user experience, this also allows you to implement risk dashboards for users. Like I said, right now, like the base metric that a user is shown on any lending market is their loan to value ratio, but that number really doesn't mean anything unless you put it in the context of the assets at work, right? So like, for example, like was it a year and a half ago now, when the Aave liquidity mining was still happening, you could deposit USDC, borrow USDC, loop it up, folding it or however you want to call it, basically deposit USDC, borrow USDC, redeposit the USDC you borrowed, borrow some more USDC, and keep doing this, right? And you could literally leverage your USDC position up to the liquidation loan to value ratio and make a bunch of money on it because you're getting paid on both the borrow and collateral side. Your LTV would be horrible, but you would be completely unliquidatable because whatever happens to USDC happens on both the collateral and the borrow side, right? However, if you did the same exact thing by, I don't know, borrowing, like depositing Matic, borrowing USDC, swapping it for Matic, and creating a super long leveraged Matic USDC position long up the liquidation LTV, or even less than the liquidation LTV, that would be way riskier than the example that I gave before. So it's really important to like shift away from these like very static metrics and construct more dynamic quantifications of what users are putting themselves subject to on such protocols. And so with that, I'd like to thank you. You can read more about this on our protocol's site. We have a research page, and if you can tweet me on Twitter or you can find me on Telegram. And thank you very much.